Welcome to Implied with Zein, where conversations about value, strategy, and market signals are unpacked for the GCC markets, with insights that travel far wider.
Welcome back to Implied. Picture a telecoms giant surprising the market and raising its dividend commitment by nearly 40%. Or a city of skyscrapers pledging to float its crown jewel companies on the stock market. Or a celebrated healthcare firm that collapsed overnight because one investor sounded the alarm. Well, these aren't hypotheticals. They are real stories from our markets. And they all revolve around one idea: signals. Today, I want to explore how companies send messages to investors and why some messages carry weight but others get dismissed. A signal is simple. It's one party sending information when the other doesn't have the same access. Economists call that information asymmetry. Simply, when one side of a deal knows more than the other, they can send a signal or some action to reveal something useful about their hidden qualities. If the signal is convincing, the receiver updates their beliefs and they act on it. Now, signaling applies perfectly in markets. Insiders know more about their company's prospects than the outside world. And investors are left guessing, is the company as strong as it claims, and if its outlook is genuinely strong? So, signals are the language through which insiders answer those questions without giving away everything. But of course, not all signals are equal, and this is where the discipline of game theory gives us two important concepts: cheap talk and costly signals. Cheap talk is exactly what it sounds like. It doesn't cost anything. It's free, it's easy to say, and it's hard to verify. And I want to stop here for a second just to say that the term cheap talk wasn't meant to be rude, because when economists Crawford and Sobel coined the term, they simply meant to explain that it's a form of message that is freely sent and it cannot be verified. And they used the simplest term to describe it. So anyone can engage in cheap talk because saying something is easy, and this is especially true if there's an incentive to exaggerate or mislead. Think of a press release that claims we're confident about next year's growth. No further details, no proof, just words. This can be considered cheap talk because it costs nothing and may or may not be believable. And this kind of talk is easy to be skeptical about. But not all cheap talk is worthless, because if it's backed with hard data and trust, it can still work. But at the end of the day, costly signals carry more weight because they come with a price. A CEO claiming confidence without backing it with evidence is considered cheap talk by Crawford and Sobel, of course. But the same CEO buying the company's shares with their own money is a costly signal. The cost makes it credible because only someone who truly believes in the outcome would take that risk. Now, you might ask, don't we all have access to the same information today? Financial reports, press releases, presentations. In theory, yes, but in practice, no, because equal data doesn't mean equal interpretations. Two investors can read the same report and come away with opposite views, and that is perception, and it depends on skills and trust. And I want to focus on trust here because investors who don't trust the source of information will not interpret that information as a fully credible signal. A transparent and consistent management team is more likely to earn the benefit of the doubt. But a management team with a history of broken promises will only see investors assume the worst. My point here is that once a company loses trust, the gap between reality and perception widens by a not so small margin. Now, maybe everyone has equal access to information, but that's exactly why smart investors try to gain information advantage. Portfolio managers need to beat benchmarks, right? So they try to read between the lines. They pay for proprietary research and they analyze tone, body language, even what's not said. It just shifts the game from what you know to how you interpret it. I also want to touch a bit on forward guidance because it can be one of the strongest signaling tools. When companies send signals about their outlook, whether financial or strategic, they don't do it out of generosity, I'll tell you that. They do it out of necessity. They do it to shape market expectations. Guidance is essentially management saying, here's what we anticipate, and by telling you, we're staking our credibility on it. This can be considered a costly signal because reputation and credibility is on the line. Let's make this a bit practical. In August of 2024, STC in Saudi Arabia introduced a new 3-year dividend commitment. They essentially raised the quarterly dividend by almost 40%, which was not a small increase. It was strategic, and it spoke to the company's confidence in sustaining cash flows. For investors, that type of commitment changed their expectations, and before you know it, STC's share price jumped 10% on the same day. That dividend commitment was a textbook costly signal. Now, take Dubai's recent IPO program. In 2021, Dubai had a smaller market with fewer listings, and instead of just talking up the market's potential, the government took a bold action. The government pledged to list 10 government-owned companies on the Dubai financial market. And the companies included big infrastructure names that would essentially add billions in market capitalization and new investment opportunities. Of course, this wasn't done in isolation because it was paired with structural moves to supervise the markets and enhance transparency. This was policy, yes, but it was also a signal. Dubai was basically sending a message about the entire market's credibility and the government's commitment to it. Listing state-owned crown jewels is costly because it meant exposing government businesses to public scrutiny and giving up ownership stakes. That's why it was credible. The message was, we believe in our market's future so much we're willing to wager our own skin in the game. And it worked. The market saw a surge in investor interest since 2021. The key takeaway here is that Dubai's strategy of costly signaling rather than, let's say, promotional rhetoric helped differentiate it and draw capital in. And investors heard the message loud and clear. Now the opposite. NMC Health was once a star company in the UAE. It grew rapidly and even listed on the London Stock Exchange. It even reached the FTSE 100 index. For many years, the company's management projected confidence and investors trusted those signals. Then in 2019, a short seller called Muddy Waters published a report claiming that NMC inflated the assets and understated the debts. It was a costly signal because Muddy Waters had bet money that NMC's share price would fall, and so the market's reaction was immediate. NMC essentially lost a third of its market cap in a single day. And as you would expect, the company initially denied the claims, insisting nothing was wrong. But under pressure, NMC's board opened an independent investigation, and it shockingly confirmed that the company had over $4 billion in hidden debt. The company, of course, collapsed. And that is the dark side of signaling, because even the most sophisticated investors can be misled by the optics. So what's implied here? We saw how signals move markets. Some signals are cheap, some costly, some companies build trust, others destroy it. And for investors, NMC served as a reminder to sharpen the due diligence process. And that puts equal pressure on companies to recognize the signals they're constantly sending to the market. Because signals that cost you something are the ones investors are most likely to believe. Next episode, I'll talk about some clever but ethical ways investors use to gain information advantage in a world where supposedly everyone has equal access to company signals. I am Zein and this is Implied. Thanks for listening.
You've been listening to Implied. If you found this useful, follow the show and share it with a colleague or friend. It helps more people discover the conversations. For episode alerts and show notes, subscribe at impliedpodcast.com. And if you have thoughts, questions, or even pushback, we'd love to hear from you. Remember, nothing here is an endorsement or investment advice. Thanks for listening, and see you next time.